Manufacturing jobs are flooding back to America's Rust Belt, but the housing crisis they're creating is making these revival zones more unaffordable than Silicon Valley. That's not hyperbole. That's what the data is actually showing us right now. I'm going to show you something that mainstream economic coverage has completely missed. While tariff policy succeeds in bringing factory jobs back to Ohio, Pennsylvania, and Texas, it's simultaneously triggering a wage housing gap that's worse than anything we're seeing on the coasts. And here's the kicker. Most people moving to these regions don't see it coming. Let's start with the headline number. In the past 18 months, manufacturing employment in Ohio has grown by 12.3%. That's real job creation. Wages in these facilities are averaging $28 to $32 per hour. Solid, middle-class work. Compare that to the 2009 recession era when these same plants were shuttered, and you're looking at what appears to be a genuine economic revival. But here's where it gets weird. Housing costs in Columbus, Cincinnati, and Toledo have surged by 31 to 44% in just 2 years. A median home that cost $185,000 in 2022 is now $260,000 plus. Meanwhile, housing costs in San Francisco fell 8% over the same period. Austin dropped 12%. This is the inversion nobody expected. Chart showing wage growth versus housing cost divergence. Why is this happening? 3 mechanisms, all tariff-related. First, the wage signal attracts migration. When factories open with $65,000 to $72,000 annual salaries, real money in Midwest markets, workers from underemployed regions move in. Suddenly, demand for housing explodes in cities that had stagnant real estate markets for 15 years. Supply hasn't caught up. Zoning is still restrictive. Building permits take time. Basic supply and demand kicks in. Prices shoot up. Second, investment capital follows wages. Real estate investors and corporations see manufacturing wage growth, assume long-term regional stability, and start acquiring residential properties for rental conversions. This further constrains ownership supply. Rent increases pull up home prices. A $28-hour factory worker can't outbid institutional investors for available inventory. Third, and this is the subtle part, tariffs are causing supply chain restructuring that triggers additional inflation in construction materials. Tariffs on steel, aluminum, and lumber affect the cost of building new housing. So even as demand explodes, new construction becomes less profitable. Builders hold off, prices climb faster. Real example walkthrough. Let's put this in real numbers. Take a factory worker in Youngstown, Ohio. New job offer, $70,000 salary. Excited, right? That's 40% above his previous position in Georgia. He calculates affordability. At that income, he can theoretically afford a $280,000 home, assuming 4 to 5% mortgage rates and 20% down payment. He arrives in Youngstown. Here's what he finds. Median homes in his desired neighborhoods are listing at $295,000 to $325,000. Inventory is 2.1 months. Bidding wars are happening. He ends up stretching to $310,000, paying 96% of his theoretical max. Meanwhile, his cousin stayed in Atlanta where she works remote tech. Same income, different trajectory. She found a $240,000 home in a comparable neighborhood with 5.8 months of inventory and no competing offers. Who has worse housing affordability? Tariff revival zone worker, no contest. His ratio of home price to annual income is 4.4 to 1. Remote tech workers' ratio is 3.4 to 1. He's in a worse position despite higher nominal wages. Now here's where the wage inequality component becomes visible. Coastal tech hubs are experiencing something we weren't expecting: wage compression. When companies relocate manufacturing to Texas or North Carolina, they often don't move their entire engineering teams. They hire local talent instead. That local talent is good, but there's less competition for that specific skill set in secondary markets. Salary offers stagnate. Meanwhile, back in San Francisco and Seattle, remote work normalization means fewer people are chasing those remaining on-site positions. Wage growth in coastal tech hubs has slowed to 2.1% annually over the past year. Wage growth in manufacturing-dominant regions is running 7.8 to 9.2%. Sounds good until you factor in that housing is simultaneously becoming unaffordable at rates that wipe out those wage gains. Demographic shift. Here's who this hurts most: non-degree workers and lower-income families. They're the ones taking these factory jobs. They're also the ones with the least flexibility. A software engineer can negotiate remote work or transfer to another coast. A press operator can't. He needs to be at the factory. The tariff policy is technically working. It's bringing manufacturing back, but it's creating a bifurcated housing market where wage growth in blue-collar regions doesn't translate to housing stability. If current trends hold, and there's no reason to believe they won't, we're looking at a scenario where manufacturing revival zones become unaffordable to the workers those jobs are supposedly meant to help. We'll see either generational outmigration when workers realize the math doesn't work, or a new affordability crisis that doesn't get classified as such because nominal wages look good on the surface. Regions at highest risk right now: Greater Columbus, Southeast Michigan, Greater Pittsburgh, North Carolina's Research Triangle Extension, and suburban Dallas-Fort Worth. Regions showing unexpected stability: secondary Texas markets like Lubbock and Amarillo, where housing hasn't caught up to wage growth yet, but give it 12 to 18 months. The bottom line: tariff policy is achieving its stated goal of manufacturing relocation, but it's doing so in a way that's creating hidden wage inequality and housing affordability crises in the exact places that should benefit most. Mainstream coverage has missed this because they're looking at nominal wage growth and job creation numbers. They're not looking at the housing cost to wage ratio, which is where the real story is. If you're considering a move to a manufacturing revival zone, run the actual numbers. Don't just look at the salary offer. Examine housing costs, inventory levels, and your actual monthly payment-to-income ratio. You might find that staying put, even with lower nominal wages, is financially smarter. If you work in tech or remote positions, this is also important. You might have more geographic flexibility than you think, and some of these secondary markets are becoming legitimate options if you can lock in remote compensation. This is exactly the kind of economic shift that moves wealth, creates inequality, and reshapes regional demographics. And it's happening quietly while everyone's focused on headline job numbers. What we're watching is tariff policy working as intended, but with unintended consequences that economists aren't talking about yet. If you found this analysis useful, subscribe to Market Pulse Report. We break down the market mechanics that drive inflation, housing costs, and labor